Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
What role does time horizon play in retirement planning?
Today, I want to share some tips for managing an inheritance. Today, Ryan and I are going to talk about how to protect elderly people from financial exploitation.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Cole and Ryan from Buska Retirement Solutions and Buska Wealth Management. We're going to be talking about planning for retirement, but before we do, if you have a question you would like to see us answer, please email us at info@retirewithbuska.com. Cole, Ryan, thank you so much for joining me today.
Of course.
We are going to be answering some questions about risk in retirement. Okay? So Cole, what role does time horizon play in retirement planning?
Well, I think time horizon is something that we think about periodically when we're talking in terms of the amount of risk we should have in our portfolio. Obviously, we should be reducing the risk in our portfolio as we get closer to being reliant on these funds, especially for income purposes. You know, we've talked in the past about the sequence of returns risk. It's a new risk that you've never really faced directly before until you start taking income from your portfolio. And you want to make sure that your portfolio is well constructed so it can weather the storm if we go through a turbulent time in the market. 2022 was a prime example, a recent example, still top of mind for a lot of people out there, and especially because some people are still making up some of the losses that they experienced in that downturn. But it is that healthy reminder that if we are overexposed to risk in our portfolio, the ramifications that come with that might be difficult to come back from. We might lose too much. It might deter our plan. We may have to go to work. We may have to find other ways of producing income or facing the decision of reducing our monthly withdrawals to account for that new financial plan because we didn't have the right plan to begin with. So I think time horizon is very much part of the decision-making process when it comes to how much risk, when you take risk, what kind of risk you have in your portfolio, and certainly as you get closer to that time frame where you're going to be reliant on income from the portfolio, that time horizon should be front and center when it comes to determining that risk level of your overall portfolio.
Yeah, okay, absolutely. And Ryan, how would I determine how much risk tolerance I want in my portfolio?
So that's going to tie right into the time horizon piece, probably being the most important aspect. We actually have folks take a relatively simple quiz called the Color of Money Risk Analysis. And that's going to be kind of regardless of where they're at on their retirement journey, whether they're early on or whether they're later. And that provides us a nice guide as far as, given what your needs for income might be in retirement from your investments, what your time horizon is, but also what your personal feelings about risk are. One thing I talk about with clients, particularly those where we might remain more growth oriented, is that if this plan is to be successful, they need to understand that that involves short-term volatility. And if you have someone who is not comfortable seeing their account go down and even in a quarter or a year, then being more risky, being more growth oriented with your investments is probably not going to be a good match, because the only way that portfolio is going to be successful is if you give it the necessary time to actually work in the way that it's designed to do. And so if you have someone who is naturally more conservative, doesn't want to see their account balances go down, then investing in a riskier way, almost regardless of time horizons, probably isn't going to work, because the plan is not going to actually go in the way it's designed.
Right.
And so it's a combination of things like time horizon, like what your needs for retirement income will be, what your goals are, if it's about income generation or if it's about leaving a legacy, and also personal feelings about risk. Our job is to try and pull emotion out of it as much as we can. But if a client's just going to want to change their growth, oriented setup at the first sign of volatility, then let's not put them in that setup in the first place, because it's not going to ultimately be successful.
Right.
Yeah, the immediate instinct for a lot of clients is panic when the market goes down, right? Oh my gosh, I lost money. And obviously that's a very natural response to something like that. And it becomes more difficult to maintain that emotional control the closer we get to needing those funds. So I think approaching your portfolio from the right level of risk associated with it from the get-go is going to help to manage that emotional response, because obviously the less exposure to risk we have, the less loss will incur in a time frame where the market goes down. And there's a certain time frame where there's an amount of loss that people can tolerate and an amount that they can't tolerate. And obviously the immediate instinct when they've lost too much is sell it all, right? Get rid of all of our investments, when obviously that is the worst decision you can make, because there's a reason why on your statement they show up as unrealized losses or gains, right? You don't realize that loss until you sell the asset that it's associated with. And so if you hold on to those assets through that market downturn and then the respective recovery, you won't have lost anything in the long term as long as you didn't sell those assets. But if you're producing income from the portfolio, you're probably selling assets every month to produce that income. And certainly if we hit a downward spiral in the market, you're now selling a much larger number of shares to produce that same level of income, thereby accelerating the pace of how quickly we're spending down our portfolio. So that's where we have to have a plan for what we do in time periods of market downturn, especially when we're drawing income from the portfolio.
All right, thank you for that. And so how often do you recommend someone review their plan and their portfolio to assess where they're at?
Well, I would say that you need to be reviewing it at minimum once per year. Now, the vast majority of our clients are coming in on average every 6 to 12 months for a review. And at that point, we'll go over their performance. We'll discuss how their accounts have been doing. We'll talk about any changes that have occurred in their financial life or their needs for income from their portfolio. And we'll also reassess their risk score. So doing that on average every 1 to 2 years is a really good idea, because sometimes our risk tolerance changes without us even realizing it. It might be just a shift in mentality. It could be that something occurred in our life that pushes us more conservative or more aggressive. So revisiting that periodically is a really good idea, because we've seen several instances where, a client or a prospective client comes in for a second opinion and their portfolio is 20 or 30% more allocated in at-risk investments than they desire, and they didn't even realize that was the case. It's that set it and forget it mentality we've talked about in the past. It's not always a great idea when it comes to your allocations in your portfolio, and that happens very easily because when we think about 401ks, 401ks, 403bs, all those things that we stuff money into every single month through our employer, well, a lot of times we set up those allocations when we're young, when we start that job at 30 or 40 years old, and then we pump money into it for the next 20 or 30 years, maybe never going back and revisiting that allocation. So when we get to 60, we're still investing like we did when we were 30. That might not make sense because our risk score has most likely shifted downward in that time frame. So it's really important to revisit that as frequently as we can, at minimum every 1 to 2 years, I would say.
So if you wanted to minimize risk, Ryan, in your portfolio, how would you diversify your portfolio?
So diversifying amongst assets is a great risk reduction method. However, simply diversifying amongst one or two asset classes may not be getting the job done.
Right.
The standard way, and 2022 is actually a phenomenal example of this. I think it actually reminded a lot of investors that the relationship that they maybe thought existed doesn't necessarily.
Right.
So people will allocate to stocks and bonds and think that's like, I'm fully covered, and when my stocks go down, my bonds will go up, and when my bonds go down, my stocks will go up.
Right.
Then 2022 happens, and their stocks and bonds are all down. You're in a 60-40 portfolio, might be moderate, conservative, and all of a sudden you're down 15-20%.
Yep.
And you thought you were being pretty conservative. Mm-hmm. And so diversifying into making sure you've got, especially if you're getting close to retirement or in retirement, making sure you have some money that is principally protected, which basically means if you put the money in there, that's going to be the minimum balance.
Right.
Is going to be really important, because that's going to be the money that you want to draw on for income in times when the markets are down. And those, if you're retired for 20, 30 years, those are inevitably going to happen. You should just take that as being par for the course. So making sure you've got safe money in there, stuff that's not going to be exposed to downside risk, is going to be extremely important. Now, for most investors, that doesn't mean you put all your money into those vehicles.
Right.
Again, we want to remain diversified. We still want to be able to utilize the growth investments, but the key part is making sure that they are in the proper proportions in your portfolio.
Right.
When you're a young investor, you might be all growth oriented. You shouldn't necessarily have a lot of safe investments outside of what you're just using for general cash flow.
Right.
When you start getting into what we call pre-retirement, though, the years approaching retirement, we do need to start considering getting you prepared for retirement, so that the stability and the sustainability of your retirement isn't entirely dependent on how does the market perform, or is it performing when I'm retiring or shortly after I retire.
Right.
So making sure we're getting prepared ahead of time, like Cole said, addressing or looking at our risk score, at least every couple of years, is going to be extremely important, especially if we're in those years where we're approaching retirement, 5-6 years beforehand. Your risk tolerance is going to change dramatically from prior to that period through that period. So making sure that we're getting that updated and appropriately diversifying ourselves amongst different risk levels and different return levels is going to be extremely important to a successful retirement plan.
Yeah, and I think one really important nugget in that conversation there is remembering that a bond is not necessarily a green money investment vehicle. A bond portfolio in your portfolio could lose value, and of course, if it loses value at the wrong time and you're relying on that as your more conservative or safer portion of your portfolio, you may find yourself in a situation where you have nowhere you can feasibly withdraw from without locking in a loss. And so that's where that green money comes into play, in making sure that we have a clear plan for where we take our withdrawals from when the market is inevitably going to be down at some point in the future. A retirement plan that just assumes the market's always going to perform favorably is not a retirement plan by any means. We have to have that backup plan for what happens when the market gets volatile, because on average, it happens every couple of years. And so if we're not prepared for that, what we would call inevitability, then we don't have a complete plan for our retirement at the end of the day.
Yeah. Well, great thoughts on managing risk in retirement. I appreciate you both taking the time to go through that with me.
For sure.
And thank you for joining us on Financially Speaking. We'll be back with more right after this.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management. And today I want to share some tips for managing an inheritance. Now, as the beneficiary of an inheritance, you are most likely to be faced with making many important decisions during a really emotional time. Short of meeting any required tax or legal deadlines, don't make any hasty decisions regarding your inheritance. My first tip is to identify a team of trusted professionals. Tax laws and requirements can be complicated. Consult with professionals who are familiar with assets that transfer at death. These professionals may include an attorney, an accountant, and a financial, as well as an insurance professional. My second tip is be aware of the tax consequences. Generally, you will probably not owe income taxes on assets you inherit. However, your income tax liability may eventually increase. Any income that is generated by inherited assets may be subject to income tax. And if those assets produce a substantial amount of income, your tax bracket may increase. This is particularly true if you receive distributions from a tax-qualified retirement plan, like a 401k or an IRA. You may need to reevaluate your income tax withholding or possibly begin paying estimated taxes. You may also need to consider the amount of potential transfer or estate taxes that your estate may owe due to the increase in the size of your estate after factoring in your inheritance. You may need to consider ways to help reduce these potential taxes. Tip number 3, know how you inherit assets makes a difference. Your inheritance may be received through a trust, or you may inherit assets outright. Now, when you inherit assets through a trust, you'll receive distributions according to the terms of the trust. You may not have total control over your inheritance as you would if you inherited the assets outright. Familiarize yourself with the trust document and the terms under which you are to receive trust distributions. You will have to communicate with the trustee of the trust, who is responsible for the administration of the trust and the distribution of assets according to the terms of that trust. Even if you're used to handling your own finances, receiving a significant inheritance may promote spending without planning. Although you may want to quit your job or buy a car, a house, or a luxury item, this may not be in your best interest. Consider your future needs as well if you want your wealth to last. It's a good idea to wait at least a few months after inheriting money to formulate a financial plan. You'll want to consider your current lifestyle and your future goals, formulate a financial strategy to meet those goals, and then determine how taxes may reduce your estate. Tip number 4, develop a financial plan. Once you have determined the value and type of assets you will inherit, consider how those assets will fit into your financial plan. For example, in the short term, you may want to pay off consumer debt, such as high-interest loans or credit cards. Long-term planning needs and goals may be more complex. You may want to fund your child's college education, put more money into retirement accounts, invest, plan to help reduce taxes, or maybe even travel. Tip number 5, evaluate your insurance needs. Depending on the type of assets you inherit, your insurance needs may need to be adjusted. For instance, if you inherit valuable personal property, you may need to adjust your property and casualty insurance coverage. Your additional wealth from your inheritance means that you probably have more to lose in the event of a lawsuit. You may want to purchase an umbrella liability policy that can help protect you against actual loss, large judgments, and the cost of legal representation. You may also need to recalculate the amount of life insurance you need because of your inheritance. The cost and availability of life insurance depends on factors such as age, health, and the type of insurance that you've purchased. And now, here's my last tip. Evaluate your estate plan. Depending on the value of your inheritance, it may be appropriate to reevaluate your estate plan. Estate planning involves conserving your money and putting it to work so that it best fulfills your goals. It also means helping reduce your exposure to potential taxes and creating a comfortable financial future for your family and other intended beneficiaries. Some things that you should consider are to whom your estate will be distributed, whether the beneficiaries of your estate are capable of managing the inheritance on their own, and how you can best shield your estate from estate taxes. If you have minor children, you may want to protect them from asset mismanagement by nominating an appropriate guardian or setting up a trust for them. If you have a will, your inheritance may make it necessary to make significant changes to that document, or you may want to make an entirely new will or trust. There are costs and ongoing expenses associated with the creation and maintenance of trusts and wills. Consult with an estate planning attorney for the proper guidance. If you have questions about managing your inheritance, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management, and joining me today is Ryan Connor. Now today, Ryan and I are going to talk about how to protect elderly people from financial exploitation.
That's right. Bring the whole family into the living room for this one. The information we're going to cover can help you protect your parents and can help your kids protect you when you reach a certain age.
That's right. This may be valuable information for every generation. Now, the AARP article titled 5 Ways to Prevent Elder Financial Exploitation contains some very solid information.
The article says that there are more than 369,000 incidents of financial abuse of elderly people every year.
That is an extremely sobering statistic.
It sure is. It also says the losses add up to $4.8 billion every year.
And it may be higher because the financial exploitation of elders is underreported.
That's a great point, Cole. If you or a loved one has been the target of financial abuse, you may want to consider reporting it. Speaking up can help stop these perpetrators from going after other elderly folks.
The good news is you may be able to prevent the abuse before it even starts.
Now, the first step outlined in the article is to designate someone you trust as your financial power of attorney.
A financial power of attorney is someone who can help make decisions for you if you become incapacitated. Of course, it is important to choose the right person for this job.
That is so important, Cole. It's essential to choose someone that you trust, someone who you know will put your needs and best interests first.
The article also says you can designate two people. That way they can share the burden and hold one another accountable.
Now, that may be a good strategy for some families.
Absolutely. The article recommends creating a customized power of attorney document that meets your specific needs as opposed to the standard form, which may not.
That's right. Now, when you're creating this document, it's the perfect time to spell out the details. Do you want your agents to manage all of your money or just file your taxes for you?
Be specific. Spell it out so there's no confusion when it's time for the person that you've designated to take over.
Now, what if there's questionable activity on your bank account and your bank can't reach you?
Well, that's a good question. You can get ahead of this by choosing someone you trust to be the point of contact for your bank if you're out of reach. The bank or financial institution can inform your contact of the situation, but he or she will not be able to take any money out of your account.
You can also give someone view-only access of your account. That way they can keep an eye on your transactions, but they can't actually access the funds. If they see something fishy, they can raise the alarm, but they won't be able to do anything fishy themselves.
Now, the article suggests that giving someone view-only access is a better option than putting someone on your bank account. With a joint account, the other person can withdraw money, and the account becomes theirs upon your death.
So what if you don't trust anyone to view your accounts? Or what if you just want to keep your account information private and don't want anyone else to see it?
Well, there are tech tools that can detect suspicious activity. The article mentions EverSafe and LifeLock. These tools can detect missing deposits, strange withdrawals, or suspicious changes in spending patterns. If something comes up, the tools will notify you.
These services can also help you recover any money you lose. If you do lose money to a scammer, or if you're a victim of identity theft, EverSafe and LifeLock can guide you through the process of reporting it. EverSafe also reimburses attorney's fees in the event of identity theft.
Now, this is why we wanted to make sure that all generations are in one room watching this. The kids and grandkids can probably help set up some of these tech tools.
That's a great point, Cole. And here's another tip that the kids and grandkids should pay attention to. Stay in touch with your older loved ones. According to the article, social isolation is one of the most significant risk factors for financial exploitation.
Make sure to call, visit, and text regularly. If there's someone who is discouraging your elderly loved one from having contact with you or with their friends, consider it a big flapping red flag.
The same goes for anyone who pressures your loved ones into making financial decisions or who asks your loved one to hand over big stacks of cash.
There are people out there who target older folks. They'll strike up a friendship or look for the older person's vulnerabilities. Then they'll ask for money, and the older person will have a hard time saying no to their new friend.
That sounds a lot like grooming.
That's exactly what it is. If one of these nefarious characters asked your grandma for money right off the bat, she'd say no. But if they help her out with stuff, spend time with her, make her think they're on her side.
That happened to someone I used to know. A man came around and promised her all kinds of handyman work, but the neighbor saw him sitting up on her roof doing nothing but smoking a cigarette. He took her for hundreds of dollars.
That's so upsetting, and that's why you need to be on your guard, kids. Make sure your parents and grandparents are safe from these people.
Now, I'd be willing to bet that these scammers are less likely to target someone who is surrounded by supportive friends and family.
Now, that may be a safe bet, though there's no guarantee. The key is to be wary and stay on the ball.
Absolutely. And while you're staying on the ball, make sure you get to know the people who take care of your elderly loved ones. Do they receive home care? Make sure the person who comes to their home comes from a bonded agency that does thorough background checks.
And do your due diligence. Of course, make sure that their home care worker is doing everything that they said they'd do. If they're in your loved one's house to assist with activities of daily living, make sure that that's what they're actually doing.
It's harder to exploit someone whose friends and family are paying attention.
Absolutely. Now, the article only specifically mentions home care workers, but what about communal settings like assisted living? Can fraud and financial abuse happen there too?
Now, according to the National Council on Aging's article titled "Get the Facts on Elder Abuse," exploitation of elderly people also occurs in assisted living facilities as well as nursing homes.
So, say you do suspect that someone working in your grandma's assisted living is not on the level. Say that you've noticed signs of financial abuse. What should you do?
So the Consumer Financial Protection Bureau has a whole webpage on reporting financial elder abuse. It says you should contact Adult Protective Services. There's a link on the page that will guide you to the APS in your specific state.
So what's next?
Now, if your loved one is in immediate danger, you should call 911. Otherwise, you can use a non-emergency phone number to file a report with local police or a sheriff's office. Lastly, you can file a report with a local district attorney's office and request that they open a case against the person who defrauded your loved one.
So when you file a report, what information should you give?
Now, firstly, you're going to want to note the time, date, and location of the incident. Second, provide the name or names of anyone who was involved or anyone who saw what happened. Third, describe the abuse in detail. Fourth, include information about any disabilities or illnesses that your loved one may have. And finally, make it clear whether you believe your loved one or someone else is in immediate risk of physical harm.
That's a great list. You might also want to contact the long-term care authority about the incident as well.
If your loved one works with a financial services professional, you may want to let him or her know about the incident as well.
Exactly. Well, that's about all the time that we have for this segment. If you're interested in learning more about how you can protect yourself or a loved one from financial exploitation, contact our office today at retirewithbuska.com or call us at 715-355-4445. We'll be right back with more of Financially Speaking after this.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. Now, this is the same way that we communicate to our clients when we meet with them in person. And remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or to schedule that complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445. or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and the same place for another episode of Financially Speaking.